All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. This is episode 72 with Isaac Schwadel. Schwadel, did I get that right?
Yes, yes, you
Okay,
did.
great. Excellent. And Isaac's a good friend of mine. We've known each other for a while. And he is a commercial insurance broker out of the New York metro area. He does a lot of development deals and existing product. He has a unique perspective on it because he's located in one of the toughest cities to, in my opinion, to do development, which is the Big Apple, New York. And so we're going to be talking about mostly how does the insurance process work with a ground up project, and obviously it depends on where it is, but we'll have the city perspective and then an outside perspective as well. And I think it'll be really interesting, a really interesting conversation. So Isaac, thanks so much for coming on the show.
My pleasure, Anthony. Thanks so much for having me.
Sure. So how does it work? So if can you insure a piece of land? Like what goes into insuring land alone?
Okay, so that's actually a great question, and it's something that actually came up last week. So land, let's just take one step back, more of a general picture on the insurance in the United States. In other countries, it's a little bit different, but in the United States, with the tort law the way it is today, there are two aspects of the insurance. There's insuring the property, which in the case of an occurrence, something happens, fire, flood, hurricane, that type of things. And then there's damage to the property is one thing that you're insuring. And the other part of insurance is what we refer to as general liability or excess liability, which is in the event that the owner, operator, or entity, or the owning or operating entity is sued for negligence. That can be slip and fall or anything of that nature. Then as we all know, those lawsuits can go into the millions and to the, depending on what happens or the extent, and sometimes even to the tens of millions. Class action suits in some cases. And so what the insurance is always for the somehow expecting the unexpected. So you're insuring against that. So just to break it down, when it comes to the property side of insurance, there has to be something that is insurable, which means there has to be some sort of structure, either or a car, depending on what type of insurance, or a piece of jewelry, a piece of art. There has to be something of value that if that were to no longer exist or to partially no longer exist, the owner or the owner entity or the individual would be at loss of some sort of money. When you ask about land, land is not going anywhere. It's nothing's happening to it, and therefore the actual land is not insurable. And it's funny you asked that. I was actually dealing with a lender and trying to explain this concept to them. They lent a client of mine X amount of money. It was sort of an acquisition and construction loan, all in one, and they wanted insurance for the entire value of the loan. However, a nice chunk of the loan was for the acquisition of the property, and I'm trying to explain to the broker and then to the processor at the bank that I can't insure meaning we'll get to builder's risk and how that works in a second when there's going to be a structure. But if part of the loan is for the land value, there's nothing to insure, and we can write a policy, but the insurance company will never pay for that. Insurance is either replacement cost, actual cash value of what was lost. Again, land, real estate is because it's real and it's never going anywhere. So to insure the actual land on a property side doesn't really exist. However, and this is very common and very important, on the liability side, vacant land is insurable. And it's important to make sure that somebody who owns a piece of vacant land, if it's a future development site or future whatever they plan to do there, is to make sure they have proper liability insurance. Because vacant land, if it's just sitting there vacant, depending on the neighborhood, depending on what's going on, there's oftentimes that there's vagrants or there's people hanging out there doing things that perhaps they shouldn't be doing. And then if something were to happen, someone were to get hurt, or someone were to get hurt as a result of those people, or whatever exactly is going on there, that the people who were hurt can bring suit against the owner entity or the individual who owns it. And if they're not properly insured, they can be in a bad situation. So just to answer the question, simply on the property side, there's not really much property or structure, anything of value to insure. On the liability side, there is definitely liability on even on a vacant piece of land. So that's the vacant piece of land. And I'm assuming go to the next step is when you want to do some sort of ground up construction. So ground up construction takes many forms. You have in the more suburban, less dense area, you have the tract home projects where there's a large expanse of land and they build home by home or street by street. In New York City or more of the metro areas, Chicago, Nashville, Dallas-Fort Worth areas, some of those areas where they have LA, where they have high-rise buildings in a more densely popular area. That's another form of ground-up construction. And then there's just an individual who buys a piece of land, decides he wants to build himself a house, a sort of less complicated project. I guess we can talk generally and then maybe break it down to the individual. Again, the individual different types of projects. So let's start with a property because that's this more simpler side of it. And the property, again, is if something were to happen to whatever exists during the course of construction. Again, very common. Something we were dealing with a little while ago was actually a building in New York City. The fellow with the HVAC company was welding something, and they had a blowtorch and it either fell or he put it down for a second, it caught fire and caused extensive damage. So that's a builder's risk claim. It might have been shifted to eventually be a liability claim for this HVAC contractor, but just, let's focus on from the builder's risk side. If anything were to happen during the course of construction to your property, obviously you don't want to sustain that loss. So you would want to have insurance, property insurance. A property insurance during the course of construction is known as a builder's risk policy. What's unique about the policy in most cases is that it's based on the total amount, which means if you have it, let's just for simplicity's sake, you have a $5 million project. So the rate that will be given and the amount of insurance, the premium will be based on the completed structure of a $5 million structure. And if it's a 16-month or 18-month project, however long it takes, even you're going to be paying the premium from day one based on the end. So that's something to consider. There are programs, I mentioned before, tract homes. There are certain programs where there are easily to mark deliverables or easy to mark points within the project where the carriers would be more agreeable to to paying pay as you go model. But for most projects, that's not how it works. You're going to be paying on day one based on the completion of the project. Another thing that makes a builder's risk policy unique, different than a regular property policy, is that it's not necessarily annual. You can, at the beginning of the project, you can, based on the projections from the general contractor and whatever else you have, going on, you set either 16, 18, 24, however long you think the project's going to take, and the builder's risk will span that amount. The advice that we give meaning as opposed to just an annual policy, the advice that we give our clients a lot of times is try to budget yourself a little bit extra time, because extending a builder's risk or extending any project-specific policy, which we'll get to in a second, can be expensive, and you're sort of caught in a bad situation. If I was just trying to help somebody, unfortunately, they came to us a little bit too late. They got me the information Wednesday night, and the policy was set to renew on a Sunday. It was a rather large project, but the situation they were in is they underestimated the amount of time that the project will take, and then the renewal or to extend the policy, the rates were just through the roof. So, and that could be, and in this case, it could be based on a number of things. Either the carrier just knows that they can charge because they know you're in a bad situation, or if there were to be a claim in the middle, then the carrier will be more hesitant to extend the policy at the current rates. However, if you think it's going to be an 18-month policy and it turns out you really need 24 months, if you originally budgeted 24 months, you'd have that same rate throughout. But if let's say there were to be a claim, somewhere at the 12-month mark, and then the 18-month mark you wanted to renew, the carrier is going to say, hey, wait a second, I'm going to want to charge more money. So it's always good to give yourself a little bit more room better safe than sorry, which is a theme you'll see that throughout the insurance industry, we try to advise people. But when it comes to time, especially, and we all know projects get delayed and pushed off, and especially now with a construction moratorium in many of the states, so things got a little bit delayed. But even in regular circumstances, things almost nothing ever goes completely as planned. So it's always advisable on the builder's risk to give yourself a little bit of room. So that's basically on the builder's risk. There's different considerations, different carriers, depending on where the property is. If the property is more coastal, tier 1, depending on where, close to the water or high wind risks, certain carriers will or less carriers would be interested, but that's standard with all property policies, that the location makes a very big difference. Again, location can be a number of things. Like I said, either close to the water, weather considerations, crime and vandalism scores are something to consider, and that's something to consider either way. At any time you're looking at a property, whether it's a ground up construction or whatever it is, it's very important. Besides from the investment side of it, to take to consider the crime. The insurance carriers are extremely aware and up to date on the most current crime scores. I was just working on something. I won't say the name of the city, but a certain city that unfortunately has been on the decline for some time. And the carrier that wrote the policy, this literally happened on Friday. The carrier that wrote the policy last year at a great rate told us that based on the increased crime scores, we are not writing anymore in that area, and we had to. We did a lot of marketing. A lot of searching around for carriers. We were able to get a good rate, but not as good as last year because of this crime. So crime plays a very big role when it comes to insurance rates. So and that's the same thing on builder's risk. The basic underwriting process that that goes on any property policy. And again, just so you're not caught by surprise, the premium is based on the final product, even though the final product is not going to be until the end, which is a little bit unique, but that's the industry standard. That's on the property side, basically how it shakes out. Again, on a lot of these projects, especially larger projects, there's going to be a lender. The lenders have their requirements of how much they want on the liability side, but on the property side as well. Always make sure, and I try to stress this to my clients and anyone that I meet, always make sure you have the lender requirements in hand. Bug the lender as soon as you get the loan commitment, bug them for the insurance requirements, because oftentimes they'll push it off because, in the bigger picture to the actual mortgage broker, it might not seem like a big thing, but to push off the closing or to be scrounging around at the end because we're looking for a quote and we need it by, yesterday, is never a good situation to be in. So if they can give you the information as early as possible, so the broker or agent, whoever you're working with, can go out to the proper carriers, explain to them what's needed, and, put you in a good position that you can close when you can, again, on the property side. When it comes to the liability side, that's where it gets a little bit more complicated, and because there are a number of different options of how to approach this. So just a drop of background, every project usually has a general contractor. Now, some of the larger companies, even the larger holding companies, meaning they own a lot of real estate, they have an in-house general contractor. Some don't, and on the smaller side, you're going to hire a general contractor to take care, run the project and build you essentially what it is that you want. Every general contractor has a general liability policy. In every state, they can't get a license without it. They need to have a current general liability policy, and most of them, again, if they're doing any sizable project, they'll have some sort of excess liability. Just quickly, excess liability is a general liability policy has what's in most cases is either 1 million per occurrence, 2 in the aggregate, or 2 million per occurrence for the aggregate. And what that means is that in any one single claim, the most that carrier is going to pay out is $1 million. In the case of the 1-2, the 2 in the aggregate means that the policy limit for the entire policy is $2 million. So either you have 2 $1 million claims or a bunch of other claims that equal up to $2 million. And once you hit that point, the carrier says, I'm no longer involved here. Either take it on your, figure it out yourself, or there's what's called excess liability policy, which is after the limits of what we refer to in the industry as the underlying policy, which is the general liability policy. After those limits are exhausted, you then go to another carrier who will kick in the limits, those limits. So when choosing a general contractor, it's always important to make sure that they have the proper insurance. Again, depending on the size of the project, what the industry standard is 1, 2, and then 5 million on top of that. Again, but then depending on the size of the project, and usually it balances out. If you're doing a really large project, you're using a pretty reputable contractor who's going to have the right insurance. So that's on the general contractor side. But then the question is, on the ownership side, what are you doing to protect yourself against slips and falls, construction accident, anything that third parties damage that might not be clear, or that you're brought into a suit even if it's really not your fault, but defense costs, all that stuff costs money. As the owner, how you defending or protecting yourself. So there are a number of options of how this shakes out. The most basic option is what's referred to as an owner's interest policy, which essentially is the general contractor has his policy. He works all the work, anything that's related to directly to what happens to the construction is his own problem. If someone were to slip and fall or whatever, someone's coming to look at it's a project being built in phases. Again, this is done in New York City on some of the taller buildings they build. The top 30 floors can still be under construction, but the bottom 30 are still are being shown already. Or in the case one of the projects that we're on, there's retail on the bottom floor that's open and flourishing, or was flourishing, but and then the upper floors are still under construction, and someone for whatever reason gets hurt, and it's not clear that it's any contractor's fault. But either way, if someone gets hurt, the first person they're turning to bring a suit against is the owner, the owner operator entity. So you have to make sure that you're protected, and that's what's referred to as an owner's interest policy that will only protect the owner. And then in the case of a lender, the lender is going to want to be added onto that policy as well. That's the most basic way. The way these things out, the way to figure out on a project, and often on smaller projects, that's often the way people go. It's least complicated, and that's the way it's going to operate. Then there's another option, which is owner GC, which is what you do is, even though the owner GC, and that's all referred to as a project specific, which means that even though the general contractor has his own general liability policy for whatever operations he has, for this specific project, he's going to be insured on this specific policy, project specific or job specific policy. And the people or the entities that are insured on this policy is the owner entity and the general contractor are both on this policy. That's from a financial standpoint, depending on the size of the project, that sometimes makes more sense. Again, depending on what the rate the contractor is paying on his general liability policy, depending on his history, depending on a million factors. It could be that the rate that he pays, usually the way it's based is either based on payroll, based on sales. Most general contractors are going to be on sales, so he's going to pay his insurance company, a rate based on $1,000 per sales. And most of the time, there'll be a line item in the budget or the proposal that they're going to give to you as the owner, and you'll see, the rate per thousand, whether it's inflated or deflated. That you have to take that up with them, but they'll give you a rate for insurance. And if you speak to your broker and they say, oh, we can get a project-specific policy that can be more cost-effective, sometimes that's the way to go. Again, on a little bit bigger, on bigger projects between, a little over 4 or 5 million. Again, with a lot of things, insurance, there's no set rules, but usually projects over $4 or $5 million, it makes sense to at least explore the option of a owner GC project-specific policy. But the consideration something to consider when going that route is you have to know the the general liability, the general contractor's loss history. Because if they have bad losses, then you're not going to have an easy time getting competitive rates on the policy. Chances are, if they have bad losses, that their regular general liability policy is also pretty expensive. So it becomes a toss-up, but it's something to consider. And I don't know if any of you see my post on LinkedIn. From time to time, I post about that when interviewing or considering different contractors, it's definitely, especially on larger projects or even on smaller projects, something always to consider is the loss history of this contractor. How safe are their sites? Are you going to be dragged into lawsuits? Are things going to get complicated, or will things go smooth? Inevitably on construction sites, especially larger construction sites, just I was telling someone the other day, I read at the beginning of the year, the Hudson Yards project. For those in the audience who aren't familiar, in New York City, it's a $100 billion construction project. A couple of really super tall commercial, residential. So there, just to give you an idea, there's about $150 million worth of claims. This is just from workers getting hurt, on the job site. So it's inevitable that people are going to get hurt. Inevitable. Again, outside of New York, the laws are a little bit different, so the claims are a little bit less. But almost, if you're in any metropolitan area or any place with a lot of foot traffic on the street, there's you hope and pray that nothing happens, but unfortunately, often the case is that there are injuries, and it's always best to make sure that you're in a good spot, so that you have good insurance. The general contractor has good insurance. So that is again, the in a nutshell version of this other option. Again, owner GC, project specific. Then on the really, really large projects there's an option known as a wrap-up policy. And what a wrap-up policy is, just to go backward in order to go forward, the owner GC policy that we were referring to before, like we said, only insures the owner and the general contractor. All the subcontractors have to carry their own insurance. And as a good actually, some of the carriers on the owner specific, or by now most of them on the project specific owner general contractor policies, are going to make sure that those subcontractors are properly insured. They'll have to submit a certificate, and then to run through their different system, automated systems, and then sometimes someone will actually lay eyes on it. Sometimes they'll ask to see a copy of the policy. There are a lot of to make sure that everyone else downstream is properly insured. And the reason is, just to, again, without getting in too technical, the way these claims work, let's go back to the claim I was talking about before, where this fellow put his blowtorch down. So let's say somebody would have gotten hurt. Let's say, I don't know, or he threw something and it landed out. Bricklayer was careless, and one of the bricks that he was putting up, or that was on the scaffold, fell off and hit a pedestrian in the street who got very badly hurt. So what's going to happen is the pedestrian is going to find a lawyer. The lawyer is going to look. In New York City, all the information is all over the construction site, and a lot of big cities like that as well. In the smaller suburban areas, the information is public. It's not difficult to find the information. They're going to find the owning entity, and they're going to say, this pedestrian got her walking by your construction site. We're suing you for $1.5 million. Then what the owner operator, the owner operating entity is going to do, again, if they have this joint policy with the owner and the general contractor, what they're going to do is find the bricklayer's policy, and the term used in the insurance policy is tender the claim, which means that they're going to say that even though our insurance company is going to deal with this claim because we're the one being sued, but we're going to pass that claim to this subcontractor, and their insurance should pick it up and either indemnify us or indemnify the pedestrian directly. So that's why it's important to make sure that the lower tier contractors have the proper insurance as well. So that's in the case of the owner GC, or when the lower tier contractors are carrying their own insurance. In the third option, which is known as a wrap-up policy, or sometimes known as the OSIP policy or CSIP. OSIP stands for owner controlled insurance policy. CSIP is contractor controlled insurance policy. And both of them together are referred to as a wrap-up policy. And what that does is very similar to the project specific, but it includes everybody who's on site. Meaning you have the owner entity, the general contractor, the plumber, the electrician, the HVAC, and the steel guy. Everybody is, in the way the process is they're enrolled, and we do this in our office as well for larger projects. You keep some sort of record of the scope of the work they're doing, the construction value, and a couple of other details. All that is compiled. We keep it on record, and again, for different places in New York, the law is that we actually have to enroll them and send it to the carrier. Outside of New York, it's a little bit different. But the bottom line is that every single, starting from the owning entity all the way down to everybody, in most cases, are under this one insurance policy. And what that does is, it does a number of things. And why on larger projects it makes sense but the most basic is that it makes sure that everybody is properly insured. This way the owner knows that he's not, especially on a larger project, there's the general contractor who hires a plumber, and then if it's a really large project, that plumber might not be able to finish in the time, in the allotted time. So he'll hire a subcontractor or two other plumbers to help him finish. And even though he might have the good insurance, they might not have the good insurance. And sometimes things can get lost, and you can have somebody, on the construction site with less than ideal insurance, and something happens because of them. And then again, on a bigger project with a larger loss, there's a lot more to lose. So when this wrap-up policy is used, the owner has the peace of mind, or the development corporation has the peace of mind that everybody is properly insured. Another option, and this is more pertinent to New York, but in other places as well, is that we all understand that different trades have different risk levels. I mean, the fellow who's doing, going up on the outside of the building and putting on the curtain wall, the glass panels, and the fellow standing inside putting down the flooring, obviously have different risks of hurting other people, of getting injured themselves. So their insurance rates are going to be very different. So what this wrap-up policy does sort of is an equalizer, is that whatever company is going to underwrite, they get a scope of the work, a budget, they do a significant underwriting to understand what's going on. And it's a flat rate for every single subcontractor most of the time. So, your crane and your steel guy, who normally will have a really high rate, is going to come down significantly, and then maybe your flooring guy, who's a lower rate, is going to come up a little bit. But at the end, most of the time, it's to the development corporation or the owner entity benefit that it comes out to be less expensive. Endeavor when it comes to insurance, and especially in New York. Just to talk about New York for 1 second, construction in New York is the most expensive construction in the world. And one of the reasons, I don't want to say the biggest, but one of the major factors is what's known as New York State labor law. And what that does, or that gives rights to injured employees. And just by contrast, to explain, any other state in the United States, if an employee, employee ABC is doing whatever he's doing, let's go back to that fellow hanging the curtain wall, so he's on a scaffold or whatever he's doing on the outside of the building, and he falls or he gets injured. In every other state, every other state in the United States, that's a workers' compensation claim. He goes in front of the workers' compensation board, presents his case. 9 out of 10 times the board will side with the employee as opposed to the employer. That's just the way it is. They'll give him the medical expenses, loss of work, and loss of wages, and whatever else it is for how long it is. In New York and New York State and New York City, it shines. What happens is that worker can now go, and he cannot sue his direct employer, but he can sue everybody upstream from his employer on a liability suit. Meaning, let's say he's a plumbing subcontractor, so he can sue the plumber that hired them, the general contractor, and the owning entity. And those lawsuits, like I said before, the Hudson Yard example, are in the millions of dollars, and and what that does, and the way everybody protects themselves by having insurance, and then that makes the insurance rates go up, and that gets passed on to the cost that doesn't get lost. It gets passed on to the owner entity, and then the owner entity passes that on to the event. Either it's if it's a rental unit or it's a condo unit, it gets passed on to the eventual end user. But that factor changes New York construction in a major way. It's fall from heights, a couple of different excavation, a couple of different trades that. You mean fall from heights could be somebody's, adjusting a light fixture, and they fall off a ladder, and that's considered fall from heights. Again, they can, besides for their workers' compensation, they can also file a lawsuit, which again they become really expensive. And again, the bottom line is that the end user is affected, but everybody's paying a lot of money for insurance in New York. Just to give an example, we were involved in a project in New Jersey, in Jersey City, which, at some points you look over, you can't even tell that you're not in New York anymore. But the costs of the trade contractors, the amount they were paying for insurance there, and then the cost on the projects that we're involved with in New York City, are the contrast is astounding. It could be like outside of New York is less than 1%, 0.5%, 0.3%. It could be really, really low, that even a high risk contractor could be paying for their insurance. And then once you get to New York City, it jumps like 4, 5, 6, 7%, depending on what they're doing, depending on, again, their loss history. And it could be, it can be crazy. I've met with countless contractors of different trade contractors who told me that, I'm being choked out. I can't even make any with the amount of money I'm paying in insurance. And, if it's a union shop and things like that, they're being choked, until almost out of business, which is unfortunate, but it's just the way the laws are set up in New York. I mean, I'm sure everyone's familiar with that famous picture of the guys eating lunch at Rockefeller Center, and with no harness, no anything, just sitting there on that piece of steel. So I guess the way construction was done in the beginning of New York was, people were just working without any safety, without any repercussion, led to this legislation being passed, and it's been like that ever since. And again, there has been every couple of years there's some push to change it, because again, it would change New York City construction costs tremendously, but it never been successfully pushed through. So that's why when it comes to New York, that's one difference in New York. Another difference in New York is because of the density, and because of the common occurrence of building one structure either at very, very close, a lot of times right up against another structure, like you build a building in between two buildings. The Department of Buildings in New York City has, and I won't go through all the details because it depends on each of the projects, but the Department of Buildings does have a very strict guidelines of what insurance must be carried for on the project. I mean, again, depending on height, depending on excavation, depending how close you are to how close the two buildings are at the lot line. There are a bunch of different factors that play in. Again, all that makes sense. Obviously, the higher you go, the bigger liability. The closer you go to the neighbor buildings on each side, there's more of a chance you might do damage to them. So the city has put in place very, very strict guidelines, and you can't get a permit to start construction without showing proof that those limits are in fact in place. So I hope we did, covered some very basic insurance details about ground up construction. If anyone wants to reach out, are you okay with sharing the contact information?
Absolutely. What's your contact? How do people find you and learn all
Yeah.
about you? Because Isaac is the insurance guru, from what I understand.
Wow, look at that. Okay. So I'm on LinkedIn, Isaac Schwadel. It's ISAACSCHWADEL. My email address is the letter I, then S as in Sam, CHWAD as in David, EL, and that's at eAllshore. So it's the letter E, then ALLSURE.com. My direct line, my desk is 646-448-2625. I hope you found the information would say somewhat enjoyable but informative. And if you have any questions, feel free to reach out. And do you have any questions, Anthony, specifically?
I have a lot of questions. Unfortunately, we have to
Right.
we're running
Wrap
out
up.
of time
Right.
here. But what I'd like to do is, and again, thank you so much for coming on,
My
Isaac. I really
pleasure.
appreciate it. What I'd like to do is I want to have a webinar, and for you to talk about all these topics in front of hundreds of people, hopefully,
Okay.
and in the near term future, so we can kind of get the questions in, which would
Sure.
be perfect. So we'll set that up after this podcast. And again, this is Discovering Multifamily, episode 71. Really appreciate everybody for listening. If you want to learn more about my company and what I do, go to redknightproperties.com and check us out. And also, if you want to reach out to Isaac through me, if you want a warm introduction as well, just go to redknightproperties.com, reach out to me, and I can facilitate that introduction. So again, Isaac, really appreciate you coming on, and thank you for all our listeners.